Welcome, and thank you all for joining us for this episode of the Crexi Podcast, an insider's look at all things commercial real estate. In this show, we cover a broad range of topics that cater to both CRE newcomers and industry leaders alike. I'm your host, Shanti Ryle, Director of Content Marketing here at Crexi, and today we are very, very excited to sit down with a podcasting legend in commercial real estate, Yonah Weiss, Business Director of Madison Specs. A little bit about our guest before we get started. Yonah is a powerhouse with property owners' tax savings. As Business Director at Madison Specs, a national cost segregation leader, he has assisted clients in saving over $1 billion in taxes through cost segregation, which we're going to talk all about today. He has a background in teaching and a passion for real estate and helping others. He's a real estate investor himself and also host of the top commercial real estate podcast, Weiss Advice. Yonah, welcome to the Crexi Podcast.
Great to be here, Shanti. Thanks so much for having me on the show.
Yeah, we're so excited to have you here. It's been a long time coming, I feel like. We've been, like we were talking about before we started rolling, in the podcast spheres, both of us, for about 5-ish years or so now. And it was inevitable, you know, I think.
Well, I'm glad we can finally connect. Absolutely.
Absolutely. So I know I just covered a little bit about your background, but, you know, I'd love to get into it from your own perspective, you know. So kicking us off, how did you get into commercial real estate? What was your path in education like? What ultimately led you to where you are today?
Yeah, well, as you mentioned, I had a background in teaching. So out of college, that was really what I was doing. I was an educator. Even beforehand, even from elementary school, really, I was like a tutor and was doing things like that as camp counselor and that kind of educational role. And that's kind of really where my passion lied, in education and in various roles within that industry, if you want to call it that. And so I didn't have very little or any background in business or in financial anything, to the point where I had very little, personally, very little financial like understanding, you know, of finances in general. And so it was just like, you know, live life, enjoy it, have a very meager earnings from teaching, which was extremely meager. And as I was, you know, married and had kids and growing a family, it had student debt and it just piling up. And at a certain point, it kind of became too much, to the point where we had I'm not going to go into details, but a health crisis in our immediate family that caused major expenses well above and beyond what any of, you know, my income could cover, that wasn't covered by insurance and things like that. And so I was put in a very difficult position where I needed to make some sort of changes, whether it be to get a second job or just completely change, occupations, because ends weren't being met. And I think a lot of it had to do with the lack of financial understanding from my upbringing. But like a lot of people, you know, living month to month, kind of paycheck to paycheck and, you know, getting by. But when something happens that throws a big wrench in the machinery, like you don't know what to do. And I had that moment in my life, unfortunately. Thank God I had some good friends who were able to kind of help me at that time, both just psychologically, like put me in the right position. Like, okay, this is okay. We're going to get through this. And also I had some friends that, financially helped me. A good friend gave me an interest-free loan to kind of keep me floating at the time when I was really, really struggling. And at that time I was like, okay, I need to make some changes. I just put it out there to friends and family, like, hey, I want to try something new. What are your ideas? And real estate kept coming up. This was a little over 10 years ago. Real estate kept coming up in conversation between people. And I had friends that were doing real estate in various different things. And the biggest change happened when I randomly met a friend of mine in a parking lot one day. And it's like, hey, this is what I'm doing. Kind of looking for new opportunities. And he said, why don't you come and work with me? Like, okay, well, what do you do? I knew he had been something with commercial real estate. I didn't know what it was. And he had been for years, in the commercial mortgage industry. He himself personally owned a bunch of small multifamily properties, but was doing commercial mortgages, brokering. And he's like, hey, I'm going off on my own. Maybe you want to come and just work with me. I'm like, Okay, I didn't know the first thing about mortgages. I didn't know the first thing about, cap rates and all this stuff, LTVs, all these acronyms being thrown around, which was a little intimidating at first. But I very quickly learned. I sat with him literally in his office like 4 or 5 days a week, just apprenticing someone who had been in the commercial real estate industry for a decade, and just sitting with them and learning the ropes. And that was kind of my forte. That was my in real estate. And from there, it branched off and went to different things. But I always had that, that teacher in me that wanted to continue educating in some way, some capacity or another. And I think one thing leading to another, that's really kind of how I found my way in the industry.
Yeah. Wow. Well, first, thank you so much for sharing that story. I can imagine. I mean, you hear stories about people going through that intense kind of moment of truth in their lives, especially when crises hit. And, like you said, thank God you had those support networks around you to help you out. But I think also, and I'm curious to what extent you think, having that educational, that teacher background, that innate curiosity that you have to have as a teacher.
Yeah.
How do you think that served you when you had to, go back and start from square one, essentially in a brand new arena? How do you think that set you up for being able to just jump all in at that moment 10 years ago?
Well, I think having that teaching background, like you said, it's being a good teacher is being a good student, because you learn more. You learn more from your students than you actually do from anywhere else. And so it's that curiosity, it's that really willingness to learn something new. And when you have that in you, it's like you want to learn something so that you can be able to teach it also. And so you want to be able to learn it really well. And I think one of my, if we call it this, like a superpower, if I have one, is that ability to kind of learn new things in a way that I can then teach them, even if it's very complicated, very complex subjects. And so that to me, was definitely helpful, having that background for sure.
Yeah. And so I'm curious, you get into commercial real estate by virtue of having these connections, your buddy just saying, hey, come on, work for me. Let's just do this. Then, you said he was in more of the finance side. Yeah. He had some properties owned as an investor. How did you end up in cost segregation, which is such a specific part of commercial real estate?
Absolutely. It was a journey. It took a couple of years, 2-3 years of doing various things in the industry, doing commercial mortgages, ton of cold calling, right? Networking. I got my broker's license, doing some residential, brokers. We did some fix and flips in the meantime, with my friend and I. And then literally one thing led to another. Just being open to opportunities, I think, is really where it came from. And an opportunity came. And this company, Madison Specs, they were looking for someone in the business development side. And this same original friend who I had worked for, we had no longer been together. It had been a couple of years doing different things. And he suggested, like, he randomly, again, a lot of it's, I say random, but I think a lot of it is really divine providence. Like, it's really things are happening for a specific reason. You meet someone randomly in the street. It's not random. There's a reason why that happened. So he met a mutual friend who had also been hired by Madison in the recent months at that time. And he's like, why don't you reach out to this guy? I think he just got hired. Maybe they're hiring more people. And turns out that they actually were. They were working on the business development side. I didn't know the first thing about cost segregation at that time, even though I had been in the commercial real estate industry at that time for about 2.5, 3 years. It had never come up. I had no idea what it was, but it was more like, hey, here's an introduction to this, good company. Madison is an established, firm, not only in cost seg, they have a bunch of other services, right, in the industry, very well-known name. And it was like, okay, here's an opportunity to learn something new. And I kind of had a light bulb moment when that opportunity came my way, because I didn't know what it was. And I was a little nervous, like, what is this thing? So I just reached out to a bunch of people. Yeah, exactly. Right. For most people, including myself at the time, when you hear taxes, like, no, I don't want, like, right. Your brain kind of shuts off. You're like, no, nothing to do with that. But I just naturally, instinctively wanted to learn about it. And I asked around in my network, hey, what do you know about this thing, COSEG? And asking around, I got two responses, basically. It was either, I don't know what that is. I've never heard of it, right? Which was my response initially. And the other response I got was, oh yeah, COSEG, that's, amazing. It's a no-brainer. It's like the best thing since sliced bread kind of thing. And so there was this big disparity. And the light bulb moment for me was that 99% of the responses I got from people was, I have no idea what this is. And I'm talking about people who were in real estate, who were in commercial real estate, and they have no idea what this is. And the 1%, which was the first person who mentioned to me that no brainer, was a mentor of mine, a person who very successful commercial, real estate developer, doing, large industrial, Amazon distribution centers, like huge, million square foot development sites that he was doing, logistics centers. So very successful. And he told me, Yonah, we use Madison for all our COSEGs. Like, it's a no brainer. And I was like, okay, light bulb. Very, very successful, most successful real estate person I know says it's a no brainer. 99% of everyone else in the industry that I spoke to have no idea what it is. There's a big gap here. And the gap is basically knowledge. I was like, I'm a teacher, right? People don't know what this is. This could be a perfect opportunity. And that's exactly what it was.
Yeah. Yeah, I love it. I mean, honestly, I feel like my thinking behind starting the Crexi podcast was for very similar reasons. There's this whole wide world. I mean, we are more generally commercial real estate, but a similar thing. If you take a sample of the population in the U.S., ask them what commercial real estate is, they'll be like, an office, right? I guess. Like, there's this whole huge industry with tons of little moving parts in it that people just don't know about. And I definitely, feel similarly to you in that being able to provide knowledge and education in that space, A, is super gratifying from a teaching perspective, but B, it's a fabulous business development tool. And so what I'd like to dive into here is, how did you go about pitching to Madison Specs? Hey, I see a huge knowledge gap here. Here's what I'd like to do to address it from a business perspective, and why. And how did you pitch them on the concept?
Yeah, it took a little bit of time for even me, because I had that light bulb moment right at the beginning, but it still took a little bit of time for me to kind of figure out, well, how do I do this, right? How do I educate people? And using social media, it took time, because I also, at that time, I had very little experience with social media in general. Podcasts were completely foreign to me, right? I remember a few months into it, I was invited to be on a podcast. I was like, what is this, right? I don't even know what this is, right? And that was, but it really, for me, was like kind of feeling out myself, like feeling out, first of all, learning it well enough that I can then go ahead and teach it. And then just on an individual level, like educating clients, educating people who didn't know better. And then, like I said, I was invited on this podcast. I'm very nervous because I had no idea what to expect. And then from there, it like took off, because I realized after that first podcast, this is such a great platform. This is such a great opportunity. And then I was using social media. I was using LinkedIn primarily at the time, which still is my, greatest platform that I use for business. And I was really, growing a substantial network of people in the real estate industry, growing a very big client base from that. And, most of the people had no idea what COSEG was, and were learning and realizing that this was, like I said, so incredible, such a powerful tax strategy. And so as I was doing it little by little, like Madison as a company kind of caught on. It was like, okay, something's going right. This is really working. Let's double down. Let's keep doing this. And so I started a whole webinar series, 5-6 years ago, where I was doing, weekly webinars, just teaching people, putting it out there. I was doing CPE, which is the equivalent of like continued education for CPAs, where there,
Yes,
in order for you to
yes.
keep your CPA license, you need to have continued education classes and take these, with credits, accredited, courses. And so I was giving CPE accredited courses to CPAs about cost segregation. And that to me was completely eye-opening, because in doing that over a course of several months, I had given webinars to several thousand CPAs across the country.
Wow.
And I always gave a poll, did like a little poll at the beginning of it, kind of getting the background, the knowledge of people on this subject before you start the webinar. And literally 70 to 80% of the attendees had very little to no knowledge of what cost seg was before attending this. So people who were, CPAs, supposedly experts in their field in taxation, whatever, but little to no knowledge of cost seg, which is such a powerful real estate tax strategy. And so that was very eye-opening to me as well. And, little by little, I was doing various forums through social media, through webinars, through podcasting, all that. And it kept snowballing and taking off.
Yeah. No, I mean, it really is, because on one hand, again, it's that educator's mindset, that giving and sharing of knowledge. I have this knowledge. I want to make sure it's available to a wider community because it is so valuable and useful. And that generosity is remarkable in and of its own. But if you're putting it all out there on all these channels, on social media, on podcasts, via webinars, and just making it available, then when the time comes that somebody wants to get into cost segregation, who are they going to think of besides the person who gave them all this free information? So absolutely, like it's a really powerful branding tool, and it of course takes so much work, I imagine. But in as far as how it works as a business development strategy, like, it's fantastic. And I'm sure you've seen results from it.
For sure. And exactly what you're saying. Like, I learned that very early on from Gary Vaynerchuk, right? From Gary V. He talked about this concept of being an educator in sales and in business development, and how being that expert, then just people gravitate towards you. And then when they need that thing, or when they have someone they know needs that thing, you're going to be that go-to person. So it was, and obviously that, huge branding tool, which I doubled down on from the very beginning. And it works, and it's very powerful.
Yeah. I'm curious, you said it took a little while for Madison Specs to kind of see what was going on and go, oh, like, let's invest in this. What advice would you give somebody who finds themselves in a similar situation where they have all this knowledge, they see the opportunity for their business to offer educational value and bring in people who want to go the next step as customers? How do you see, because a part of it is it's you, right? Your website is yonaHweiss.com, and then you go on LinkedIn, you're like, oh, okay, he works with this company. Right. So not all businesses are necessarily a fan of an individual employee kind of striking out and becoming the face, if you will. So how would you recommend that somebody kind of pitch that to an employer if they had that idea? Or how do you suggest companies should think about it if they see that they have an opportunity with somebody on their team like this?
It's a delicate balance, because not every company is going to be open to it. I think most will not be initially, because there's like this kind of threat, like, wait a second, you work for us, like, this is our brand. But there is at the same time something very powerful about the personal brand. And so you have this kind of balance between what, we call like an entrepreneur versus an intrapreneur, like someone who works within a company but has that kind of entrepreneurial spirit in them, and is developing that own personal brand. Because in the end of the day, most people, especially when we talk about social media, people are connecting to people, right? Not brands per se in terms of companies, right? So there is that, that B2B, it's between me and you, right? Yes, Shanti, you are, the host of the Crexi podcast, but when I'm on this podcast with you, I'm talking to you. I'm not talking to Crexi, right? And I don't even think, it's not even really in the back of my mind. Sure, I know
There's
it's
like
part.
a floating logo in the back.
Yeah, exactly. It's there. Like it's part of this thing. But if people
Yeah.
ask me, like, "Hey, were you on, that podcast?" I'm not going to think of the company. I'm going to think of the person. And that's
Yeah.
really what the goal is. And I think most business. And so when you relate to individuals, and that's the powerful of social media, that you can build your own personal brand. So it is a very delicate balance, because I think a lot of, companies, especially corporate, they feel threatened by that, because wait a second, well, what if this person, they're just going to go off on their own and start their own company, and then they're going to be my own competition. That's a lot of, so there is that threat. And so it is intimidating for a lot of people. But I think the power of giving individuals within the company the I guess the more than just the opportunity, but kind of the freedom to develop their own personal brand, because in the end of the day, that's what's going to attract that's what's going to attract customers to them, rather than the company. Like if you think about right now, the best people who in any given niche in commercial real estate, right? You think about someone who's in insurance, you think about someone who's a broker, or a mortgage broker, or a lender, whatever it is. You're going to think about that person. You may not even know what company they work for, but you're going to relate to them, whether it be because, through social media, those connections that you have, whether it be if you've met them in person at different, industry events and things like that. It's all about the person. It's about that personal touch, that personal relationship. And so you need that, that know, like, and trust kind of a triangle there. Yeah. And so you need to have that. So for an individual, double down on the personal brand regardless. And because that's who people are going to relate to. And from a company perspective, give people, if you are, you run your own company, think about this, like give people the freedom to do that, because ultimately it's going to bring people to you.
Yeah. Yeah. I mean, we see it at Crexi. We've got a few rogue people on Twitter, some people on LinkedIn, but honestly, like they'll post what they're thinking. They'll engage with people online, and they do very well. Like people have the relationship with them, but they go, and they work at Crexi. I need XYZ software. Let me talk with them. Right. Or have a question about something. I'll connect with them. And and I also just kind of thinking more broadly, there's two aspects to this, right? In commercial real estate in general, it is such a relationship driven business anyway. No matter what, people will work mostly with who they trust. And you can build that trust person to person. A layer up is brand to brand, but it starts at the people level. It's people that make up a company, not just the brand floating in space. And on the other side of things, especially for brokers who will hang their hats at a particular company, they're still contractors. They're still doing their own business. They pay their own taxes and insurance, right? So it is in their best interest to build that personal brand, even if they are with one association or another, because again, that is their business. They eat what they kill. They're the ones driving that relationship. They have their own book of business in their market. So I think, very powerful advice, and worth using that perspective if you're a broker or whoever in commercial real estate, and you're at whichever house and you're going, hey, I would like to post more in social media, not social media. Here's why. And see where that'll go. And I think, honestly, the more people like you who are doing it with success, the more examples there are to point to and go, look, this is clearly working. So I appreciate you being a standout example of that in the industry.
I appreciate you. And I try to encourage people all the time just to do that, because there is that people are uncomfortable a lot of times, especially with social media, if you're not doing it regularly. And so I encourage people to do that and just kind of get yourself out of that comfort zone. Do it consistently for a short period of time, and then it will just become almost, natural secondhand.
Before we jump into the weeds of cost seg, I'd love to know from your perspective, how do you balance your day-to-day work with content creation, with taking the time to go on the hundreds of podcast interviews you've been on, hosting webinars, et cetera? How do you find that balance?
It's more of it. They all kind of weave into one another. So it's meaning the social media and the podcasting and all that, the content creation, it's really a big part of my day. because because that leads to, everything. And I have, thank God I have an amazing team in terms of the background. That we have a marketing team. I have an assistant who helps, basically, manage my inbox and helping through the day-to-day nitty-gritty, which allows me to have more time to focus on the content creation and the social media and things like that. So it is obviously a balance, and someone who is thinking about, well, I got to make 100 calls today and I got to, go through all these emails. You need to find the time to do the social media. And for me, the more time I spent doing social media and doing content creation and that, the more business I found coming in. And so it was like, well, then I'm going to try to figure out how to spend more time doing that thing that brings more revenue, right? Than the nitty gritty things that does bring some, but not in the same way. And so it takes time to kind of develop that and to see what works and what doesn't work. But the more I double down, the more it works and pays off.
And it's fun.
Exactly.
I'm biased, but it's
well,
fun.
yeah, right. And so do what you love and do what's fun. Exactly.
Absolutely. All right. Well, let's get into it. Cost segregation. What is that? What the heck is it?
Exactly. Right. It's a weird name, and it's a weird name for a very complex but very powerful income tax strategy for real estate owners. Essentially what it is, it's an advanced form of depreciation. So we'll take a step back and understand what depreciation is. Anytime you buy a property, besides for your primary residence, whether it be residential or commercial, the IRS allows you to take a deduction called depreciation. So it doesn't actually mean that your property is going down in value like the name sounds, right? It just is a borrowed term for the name of a deduction, as if your property was going down in value. And so they say like this: you bought a property, let's say for $1 million, whatever, you now get to take an income tax write-off of the entire value of that property. Okay. But you have to do it over a long period of time, right? For residential properties, it's a 27.5-year period. For commercial properties, over a 39-year period. So they say you can take this little deduction, right? About 2% every single year of the value of your property. And so that's in of itself, depreciation is a great deduction by itself, right? Standalone, because you invest or you buy real estate, you're able to take a tax write-off simply because you own it. Right? That's what depreciation is. Cost segregation basically says, let's break down the property into its individual components, right? Little tiny pieces, and show how certain components of that property depreciate faster on faster rates or faster schedules, which if I can identify what those things are, take those deductions at a faster rate, then I can get bigger tax deductions during the earlier years of ownership, creates more cash flow. And so it used to be called component depreciation, which makes a lot more sense than cost segregation, because, right, we're segregating the cost. Yes, we're breaking down that purchase price, that cost of the property, into these different buckets or these different categories. But component depreciation says, well, my furniture depreciates on a 5-year schedule, right? My flooring depreciates on a 5-year schedule. My, the walls and the windows and the doors and the infrastructure depreciate on that longer 39-year. And so I'm breaking down the components to these different depreciation categories. And that's really, in a nutshell, what cost seg is.
Easy. That's pretty simple, actually. It's just a matter of knowing what schedule goes where and then how to put it all on your tax forms, right?
Exactly. Right. So breaking down something very complex into very simplified, understanding, that's, I think, what my superpower is, as I mentioned. And, obviously we'll get into more details to understand it more. But for most people, just getting over that hump, like, okay, it's an income tax strategy, creates more cash flow. Sounds like a no-brainer.
Yeah.
Why are not more people talking about this, or why not more people doing this, or why is my CPA not telling me about this?
Yeah, totally. It makes me think of, I remember the first year, several years ago, when I learned that I could write things off. I have an LLC on the side, and wow, that was fun learning how to take those deductions off. It's like, oh, I can get this much more back, and then this much more back, and then this much more back. It's almost like looking under rocks for just little cost saving things. It's very satisfying in a bizarre way. Maybe I'm strange.
Not at all.
So who should be looking into doing cost seg? Is there a property type or maybe an investment size or a point in an investment's lifespan where it stops making sense? How should people think about exploring this as an option?
Yeah, I think everyone should look into it, right? Meaning it's not necessarily for everyone, for every property type. So we'll talk about exceptions and where it doesn't make sense the most. But I think, you asked like who should be looking into that. I think everyone should be looking into it. Everyone should understand, for them, for their own personal gain, when it does make sense, when it doesn't make sense. And like I said, there are individuals who it's going to make more sense for, and there are property types that it's going to make more sense for. But overall, everyone should be looking into this for sure.
Well, let's get into it. What's an example of a property that would be no brainer, absolutely should explore cost segregation with, and conversely, what's an example of something that just, no, this isn't really a good fit?
So from a property type, the main thing is looking at the value of the property, because your depreciation is solely based on the purchase price. Okay. So, at a certain price point, it starts making more sense. So, and that price point is a lot lower than people think. Literally over $200,000 purchase price, right? So if you're buying a single family home, again, can't be your primary residence, but if it's a rental, right? Long-term, short-term, doesn't matter. Any type of property over $200,000 purchase price already makes sense to look into getting a cost seg done. So really any type of property. There are certain types like a warehouse or industrial property that are going to be on the lower end of the benefit spectrum, because one of the main things we're identifying that depreciate faster inside of a property are these, what we call personal property or tangible property, things that are movable. And in a warehouse, there's basically very little, right? You have the structure, maybe you might have some shelving or some security cameras or things like lighting, things like that. But for the most part, there's very little equipment, there's very little furniture, very little appliances, very little fixtures, all that kind of stuff.
Everything else the tenant brings in, right? Yeah.
Right, tenant may bring in, but in other types of commercial properties like multifamily or office or even self-storage, things like that, there are a lot of other of those components that I listed that are going to be in there, whereas opposed to a warehouse is more just kind of bones. And not much else besides that. So on the spectrum of what types of properties benefit the most from cost seg, I think warehouses are going to be on the lower end. But on the high end is going to be RV parks, mobile home parks, golf courses. And the reason why that is all those have something very interesting in common, is that the majority of what you own is the land improvements. So big distinction between land and land improvements. Land itself does not depreciate. So anytime you buy a property, you always have to subtract a certain amount for land value, which does not depreciate. So let's say you buy $1 million property. Let's say you take off 20%, 200,000 of that goes to land. And so what you're left to depreciate is that remaining 800,000. When you buy a golf course or you buy an RV park or a mobile home park, there's going to be land value, but everything else you own essentially is the land improvements, is the landscaping, the pavement, right? Concrete.
I was going to ask, is the lawn an improvement?
Exactly. Yeah, no, lawn, all the landscaping, absolutely.
Yeah.
And so that, because it's, especially golf course, it's replaced, right, over time, right? Every few years you have to replace that. And so that has value. And so what we're looking at, and all land improvements depreciate on a 15-year schedule, which is on a faster rate than that 39-year, and is eligible for bonus depreciation, which we'll get into, but allows you to take like a first-year deduction of that whole amount. And so it can be extremely powerful.
Yeah, well, let's get into bonus depreciation then. What's that?
Absolutely. So back in 2017, when Trump passed the first, what's called the Tax Cuts and Jobs Act, was a huge tax reform, biggest tax reform in 40 years. He introduced this concept called bonus depreciation. It was around before in various forms, but the 100% bonus depreciation was brand new. And it basically said like this: once you've done a cost segregation study and have identified components of the property that depreciate on a faster schedule, meaning a 5-year, which is like I said, the personal property, the 15-year, which is the land improvements. Once you've identified those, you now have the option to take as a lump sum 100% of those accelerated deductions in the first year. And so, give our example of that $1 million property, $800,000 basis to work with after land value. And let's say you can take 20% of that goes into these faster categories, the 5 and the 15 year. That means $160,000 right off the top is going to be, you can take as 100%, right? First year tax deduction.
Wow.
So pretty powerful, as opposed to, your normal tax deduction at a regular depreciation rate would be like $20,000 or $30,000 every year.
Yeah.
Get a $160,000 deduction. That's a big boost, right? Huge deduction. So that's what the 100% bonus depreciation introduced. When it was written into law back in 2017, it had a phase out component to it, which meant that starting in 2023, it started to phase out, went down to 80% bonus. Then 2024 went down to 60%. This year, 2025, at the time of this recording, it went down to 40%. However, at the time of this recording, right, we are kind of in a limbo stage because there's been a bill any minute now, right? Any minute now. There was a bill that passed in the House to bring back 100% bonus depreciation. It's going on the floor to the Senate this week at the time of this recording. So it's very likely it will have already been passed by the time this gets released to bring back 100% bonus depreciation permanently.
Always no phase out period.
With no phase out period, as it's written into law right now. Again, things may change between the time of this recording and when it gets passed into law, but starting in 2025, it's very likely that the 100% bonus is going to come back, which again is a huge boost for real estate owners.
Absolutely. So is there any situation, I mean, I can understand you're getting a huge chunk of your taxes just erased from the ledger, essentially, if you're able to take the full 100%. I'm curious, have you encountered any situations where someone has not wanted to do the bonus depreciation right off the bat? And why would that strategy come into play?
Yeah, I mean, first of all, there are situations where in general, cost seg doesn't make sense for an individual. But specifically with the bonus depreciation, if a person has multiple properties or multiple ways to offset income, and they just don't have the main reason in general why a person wouldn't do a cost seg or wouldn't want to use the bonus depreciation if they just don't have the income to offset, right? Getting a tax deduction is great, but it only makes sense if you can actually use it, right? That's a foundation of every tax deduction, right? It's amazing to talk about, $1 million write-off, but if you can't use it, then it's basically, it doesn't make any sense. It's just like, it's churning water, as they say, right? You're not doing anything.
Yeah.
So that's the main reason.
Yeah. No, that totally makes sense. I'm curious, you mentioned the golf course, but do you have any favorite examples or stories where, someone was willing to just do their basic depreciation, you introduced cost segregation to them as an option, and then they got just outsized results from doing the work?
Yeah, every time that happens, and it happens all the time, it blows me away. It really has more to do with like the individual, the story behind it than, the type of property or something like that. Like I had a guy a couple of years ago who was a very successful real estate broker, a residential broker, was like the top in his county, making 7 figures, making a lot of money. And he was in California paying like hundreds of thousands of dollars of taxes every year. Like he had a tax bill of, $300,000-$400,000. And so he came across cost seg, had owned a few properties also, like did real estate investing as well on the side, and came across cost seg. He had a multifamily property that he had bought at that time for about $4 million. It was, in California, it was probably like a duplex or something. I don't remember what it was. No, I'm just kidding. But but it was right. It was like a 20 unit. It was a small multifamily, relatively small. And because there was the 100% bonus depreciation still at play at that time, from that $4 million property, he was able to take $1 million tax deduction from doing the bonus depreciation in that first year, right? So he literally wiped out his tax liability to zero. And instead of paying, $300,000+ of income tax that year, he paid zero. And so he was able to use that extra $300,000 that he would have paid, and he bought another property, and so he's just making more money and you can finance that, right? So that $300,000, you could buy a very expensive property with that. So that was one individual that blew me away, because he was a real estate broker, very successful, making a lot of money, but still getting hit with such high taxes. The key to wealth building, right? They say it's very cliche. It's not about how much you make, it's about how much you keep, right? And that's so powerful when it comes to taxes, because the more you can lower your tax liability, the less you're paying in taxes, the more you can actually use to reinvest and then grow your wealth tax-free, basically, for as long as possible. And that's the most powerful strategy. Another one that just jumps out at me, and I've gotten this a lot over the past few years as well, is individuals kind of transitioning out of W-2 jobs because they're able to make more money after taxes by doing the cost seg than investing in real estate. And so I have a lot of people doing short-term rentals, Airbnb type properties, where you're managing it, self-managing it, and you're able to claim the depreciation against your active income. So we had a couple who were very successful in Northern California, both of them in the medical profession, doctors, very successful, and they were in their 40s, stressed out. Both of them working who knows how many hours, just having no time for anything. They started getting into short-term rentals. They had owned at that time 3 short-term rentals that they were self-managing. Amazing way to do that. And they realized by doing a cost seg on these 3 properties they had, that they would make more money after taxes if one of them retired. And
wow.
And so that's exactly what they did. One of them retired, went, kind of full-time, which again, full-time, they were spending about an hour or 2 a week managing their rental properties, right?
Oh, so that's nice. I wish it was that easy all the time. That's awesome.
Yeah, right. And so it was like, here we go from this high stress, and making more money after taxes because using this strategy. And so they were able to do that. And those stories to me are the most powerful.
Yeah. Yeah, it's nice to hear that this kind of strategy is available for those mom and pop investors too. Like, I think a lot of people kind of look at these weird tax backflips almost as just a vehicle of, giant corporations or, limited partner groups, things that they can't really tie back with a red thread to. These are individuals that are employing these tools. But absolutely, yeah, it's just a married couple with a couple properties able to have such a huge quality of life change with this. That's really incredible to hear.
For sure. And that's the biggest misconception for me that I've had over the years, is that people think it's only for big corporations or only for huge properties, right? Oh, I thought it cost like $50,000 to get this done, right? So it doesn't make sense, only on like $10 million properties and up, right? That's a huge, huge paradigm shift when you realize, no, for an individual, you own a single family, it can be life-changing. For someone who like that, saving $50,000 on your taxes for someone who, is living paycheck to paycheck is life-changing.
Absolutely. Yeah. Yeah. And just unlocks so much more opportunity and things that they can do if they just have that one chance, even if it is just the bonus depreciation that 1 year, right? So what would, kind of, let's start first with these mom and pops, these owners that don't think cost segregation is for them. What piece of advice would you give them to get them set on this path so that they can experience that life-changing moment, that aha?
I mean, education is key, right? Listening to podcasts like this, learning about things. Like you said earlier at the beginning of this podcast, when people hear taxes, and most people, their brains shut off. And it's I have a CPA. I don't want to think about that. I don't want to deal with that. But the truth of the matter is, especially when it comes to real estate, there are so many little kind of tax strategies and niche kind of ways to do things, different write-offs and things like that you really need to be on top of. You need to learn about. So education is key. And so one of the things that we always do is we always provide a free upfront analysis of any property. And so if someone has a property, they're thinking about doing a cost seg, we can show you, and it's educational just to see what the difference is. If I just took regular depreciation it would look like this deduction year after year. If I did the cost seg, did bonus depreciation, it would look like this. And so you can see it and you can make that, you have that aha moment. You have that, okay, this makes sense, right? Should I pay this much? Should I save this much? And that's the key, education.
Yeah. I mean, go reach out to Yonah, everybody. Like, get a free table. Honestly, that's such a valuable thing to have. And yeah, I think once kind of the door is wedged open a little bit, then it really opens the rest of the way for exploring all these strategies. I'm curious, before I get into more advanced stuff, what are your like 3 favorite little cost seg strategies that you like to, like, if you can find those in somebody's property, you're like, yes, like this is what I like to see.
There's a lot, I think for most people, it's just like the idea that they can do it in the first place. But one thing that comes up a lot is when people are doing renovations on properties, and and that's where you can actually, there's a way to double dip. And what I mean by that is like this, right? Typically you buy a property, the best thing to do is to do a cost seg right away, because you can identify all the different components in there that can depreciate faster. And then at a later point, if you're going to do renovations, and this isn't the case with everyone, some people do a gut reno and, get rid of stuff right away. But if you're not doing that strategy, if you're, just maybe when tenants move out or later on down the road, maybe a year or two, you're going to bring in a different tenant, you're going to do renovations at that point, you're able to take the depreciation on the original purchase, do the cost seg, get all the tax benefit with that. And then later on, when you pull out stuff, you can write off all that stuff that gets pulled out. And when you spend more money to renovate, that money that's spent in the renovations can now be depreciated a second time. Well, not a second, it's being renovation it's being depreciated the first time, but you get to basically double dip by doing a cost seg on the property a second time, based on all that new money that was spent.
Okay. Fix and flippers, take notes here. And then from a more advanced perspective, you're talking to someone in commercial real estate who knows the basics. What are some lesser known strategies or cost seg tricks that you like to whip out?
Well, I think one of the biggest lesser known tricks in of itself, not a trick per se, but one of the foundations of it is, who can benefit from this? Because we talked about how powerful this can be, and especially for people in real estate, but there are specific rules regarding the passive deductions, the passive losses, the depreciation deductions, who can use it. And so if you are full-time in the real estate trader business, you're called a real estate professional status, then you're able to use depreciation to offset any source of income. If you're not, if you just have a W-2, if you're not a real estate professional and you're just a W-2 or whatever, then you're limited and you can actually only use depreciation or cost seg to offset your passive or your rental income. And that's probably the biggest thing I think people overlook, is that people think, oh, I can do a cost seg and just not pay any taxes whatsoever. It does depend. Are you a real estate professional? Are you not? There are a couple other exceptions to this rule, but generally speaking, that's the biggest thing. So when it comes to kind of tips and tricks, the starting point is just understanding, okay, does this even apply to me? Can I even use this? And that's probably, the first thing to look at.
What if you have a W-2 in the real estate industry? Does that count?
I know. Yeah. Unfortunately, the IRS's definition of what's considered a real estate professional status is specifically related to like materially participating in ownership and management and dealing with properties themselves. Yeah. So I mean, there are, like I said, there are a couple other exceptions to the rule. The most prevalent one is the short-term rental loophole, as we like to call it, which is if you do own short-term rentals, then that rule doesn't apply to you, because you can actually use the depreciation to offset your active income as long as you're self-managing your short-term rentals. So there are rules behind that. But, in terms of other tips and tricks, kind of for a more complex thing, looking at the fine details of every property always like blows people away, because, you think, okay, personal property, what I have, like appliances, the furniture, But when it gets into the nitty gritty, you're talking about like millwork or different window treatments or things like that. There's all these little details that that people don't think about that actually benefit from the cost seg. So it's important to make sure an expert comes in and looks at it and make sure you maximize those deductions.
Yeah. Someone who knows every little corner to like look around and rock to lift up and explore. Absolutely. Well, kind of getting more into today's market. You know, we talked a little bit about bonus depreciation. Like literally we're at 11:59 on the doomsday clock of it. So we'll see. Maybe by the time this is out, this will be law. But you know, there's other things at play, right? We're still in a relative to 5 years ago high rate environment. I think a lot of people are penciling that point of view and perspective and numbers into their deals that they're doing today. They may cut rates later this year. Who knows? Been saying that for a while. But how, in the reality in which we're living in today's market, how are cost segregation strategies coming into play to get the deals across the finish line?
Well, I mean, taxes is always going to be the biggest expense, right, that any business or individual has. So if you can have a way to make an investment make more sense by paying less taxes and employing a strategy like cost seg, it can, and many times, push it kind of across the finish line. Because, yeah, I mean, from a perspective of an investor myself, I'm almost never going to invest in a deal because of the tax savings, right? I want to make sure, right, the deal makes sense in itself, right? It's going to make money.
Yeah, sure.
There's good, whether it's cash flow, whether it's, the equity that's in there, the appreciation that, potential that's going to happen from it. The tax savings are always a cherry on top, right? It's definitely good to do there. But for people who are looking at this like, well, how can I actually add more value to investors? It's certainly something to look at. But even more so in terms of in this environment, it makes more sense as a strategy for a lot of people for a different reason than maybe we're expecting. And one of those reasons is because for a lot of people, just managing existing properties that they may own and making sure that they're making money and not losing money, more importantly, is probably the most important thing for a lot of people. And since cost seg is something that doesn't necessarily have to be done in the first year of ownership, it can be done many years later. Meaning, if you've owned a property for years and never did a cost seg, now might be the right time to do it because, yeah, you may not be, you may be stabilizing, making money, but if there's a way to save taxes this year that you weren't necessarily expecting, which is going to increase cash flow, that now might be a more powerful time to employ this strategy. And so it can make sense at really multiple stages within the investment life cycle.
Sure. Yeah, that makes sense. And, approaching maybe a few years down the line, a more stabilized asset might be looking at refinancing sometime soon. So maybe they want more of that liquidity just to have a little bit more wiggle room on the table. I'm curious, what kinds, just from clients you're working with, what scale of deals are you, or rather, I guess, size valuations are you seeing come to the table to use cost seg as a tax saving strategy? Is it mostly smaller properties like the mom and pops you said? Is it more the larger institutional deals? Are you seeing any changes in any of those types of investors? What are you seeing?
I mean, because we're the biggest national company doing this, and we see really everything. So, we have from institutional, we have a lot of REITs that, we service, buying skyscrapers and buying, large shopping centers and things like that. So we have everything in between. But definitely the mom and pop, I think when the 100% bonus depreciation came into play years ago, it gave more leeway for the smaller investors to make cost seg make more sense because the 100% bonus gave bigger tax deductions. So like I said, even $200,000 purchase price and up makes sense. I think bringing back 100% is going to bring more of those mom and pop, more of those individual investors to the surface. But we see everything. And I see a lot more like syndicators, it was a big syndication bubble back. It's still around a lot, but I think there was a big syndication bubble, happening between 2018 and 2022. There was so we saw a lot more of the cost seg happening with those type of deals, less so nowadays, but it's still out there for sure.
Yeah. Are there any, we've been talking mostly about the IRS, but are there any besides bonus depreciation, whether on the federal or the state side, are there any recent regulatory changes that have come into effect or are on the table that you think people should have on their radar, and why is that?
Well, I mean, there's something not necessarily related to cost seg per se, but there are a few other tax strategies that definitely should be on people's radars that are somewhat related. There's something called the Section 179 deduction. And so that's very related to cost seg, has a lot more to do with businesses than necessarily real estate investors, which, a lot of people who own businesses don't necessarily think of themselves as real estate investors, even though they own property. And so that of itself is something you should think you can do a cost seg if you own a property, even if you're not a real estate investor per se. But Section 179 basically allows people to take a full write-off of different equipment or different assets that are bought, whether it be HVAC or, again, different equipment, things that are acquired through the business. You can take as a full write-off. So it's different than depreciation because you're not adding it to your depreciation schedule, taking it over a certain period of time. You're just taking it as a first year, straight tax write-off. So that's something very big. And I think that's also going to be increased, the amount that you could take for 179 deduction. I'm not sure the exact amount in the new bill that is coming out to increase that, but I think maybe it's somewhere in the realm of like $2 million. So that's something, it's something you definitely want to, up to $2 million for specific assets. So, we deal with manufacturing companies and different, but even like a business, if you buy software or you buy, things like that. Oh yeah, there you go.
Definitely write off my business software and my iPhone every year.
Exactly.
If you have a business, you absolutely should write off your cell phone.
There you go.
50% of the time, I feel like is a good rule of thumb.
For sure.
Absolutely.
And so,
go ahead.
Yeah, there's another one called opportunity zones. I don't know if you've had a chance to discuss this much on the podcast.
We've talked a little bit about them on the podcast, but I'd love to hear your perspective on them.
Also, extremely powerful tax strategy where this also came about in the first Trump tax reform, right? Which allowed certain zip codes, so to speak, zones in every state that were earmarked as places that needed more redevelopment, or places, zones that needed more kind of infrastructure development happening. And so they gave this tax benefit that if you invested in these areas by spending money in a property and redeveloping it or developing it from the beginning, then you could literally write off capital gains you could from other investments. And so it was a way to roll over money from other places and defer or completely write off capital gain taxes by putting money into these opportunity zone funds. So that's very powerful. Also combines well with cost segregation because if you do a cost seg, right, you can write off the income. If you do the opportunity zone, you can write off the capital gain tax. It kind of goes hand in hand.
Absolutely. Yeah. Again, looking under every rock. And then kind of looking ahead, just at the broader market, do you see any trends, whether that's in, I couldn't even tell you what trends to look at, but do you see anything emerging behaviorally from different investor groups or in different markets or with different asset classes that you think could kind of reshape how cost seg is thought of or used or just generally employed in somebody's investment strategy?
Not necessarily. I mean, it's been around for so long that it's just become almost, standard for a lot of investors in their business plan.
Yeah.
But
who
like
know
I said,
about it?
who know about it? Exactly. And so that's the biggest thing. It's just the education is just kind of pushing it out there to more and more platforms to more and more areas where people understand it. I think the biggest realm that it's still unknown of is the area of kind of the mom and pops individuals, where maybe single family investments, where it may have been not thought of to use a cost seg for smaller properties, whereas when the 100% bonus comes around, again, it will be much more beneficial. But other than that, like I said, it's been around, cost seg in various forms for 30, 40 years. So it is something that has, it's just really about the education more than anything else.
Where do you have, I mean, other than Weiss advice, where do you recommend people go to get that knowledge? Do you have any favorite books? Obviously, Madison Specs does a lot of educating and you do yourself, but any places you would refer listeners to build up that education?
Yeah, unfortunately, there's not a ton. I've been thinking about writing a book for a while now. I probably should just get around to it because there isn't really a book on the subject. Sure. I like I said, I've been a guest on like 500 podcasts, so you could, talking about this. So if you just Google my name, and you'll find more education than you could possibly need about the subject. But there is, in general, is a book called Tax-Free Wealth by Tom Wheelwright, who was the Rich Dad Poor Dad tax advisor, and he talks. He has one chapter on depreciation and goes into costing and that. But in general, it's a great book to kind of learn different tax strategies and things like that. You have the guys over at the Real Estate CPA. They have a ton of educational content on that platform. You just go to realestatecpa.com, and a lot of great stuff over there as well.
Awesome. Go check those places out. And of course, message you if they have any questions or want that free analysis. Before we wrap up, I'd love to tackle a couple rapid fire questions just to kind of leave us with some fun things to think about. Are you game? Exactly. So if you were handed $50 million today and you had to invest it in real estate immediately, like by 5 p.m. today, where would you park that capital?
That's a very challenging question. It's kind of hard to find something right away immediately. But first of all, I would spread it out, as much as possible, diversify in as many deals. Now I have a ton of, passive. I have a lot of passive investments that I've invested in over the years. And so as a limited partner, I see deals come across my desk every single day, like whether it be through clients of ours that I know, or just in general, like different ways that I'm on lists and things like that. So there are a lot of opportunities right now, like in my inbox, that I could invest in, but I would definitely spread it out. I think the main three, if I had to pick, so I'll be specific if you want, be more specific. Like self-storage is a great asset class. Multifamily, I'm still a very big believer in. Mobile home parks along the affordable housing route. So within those three, I think I would put the majority of that money in different deals. I wouldn't buy anything. Maybe I'd buy a couple just triple net outright, buy like a Starbucks or something like that, just because those are very simple, easy cash flow. They're managed, third-party management, stuff like that. So buy a couple Starbucks, and the rest I'd put into passively investing. That's personally what I would do, just because I don't like to manage. I don't like to be on the operational side of things.
You got to be on all these podcasts. You're busy.
I'm busy podcasting. Exactly.
Yeah. Nope. Totally makes sense. Any particular market you'd choose?
I am a big fan of the Southeast, Sun Belt. So I have most of my investments currently are in North Carolina, South Carolina, Atlanta, Florida, Texas. Nice. So those kind of Sun Belt area.
Love it. It's very popular. What's the craziest way you have found a new client?
Craziest way I found a new client. The craziest way I found a new client, nothing's really crazy. I wouldn't say crazy. I've found clients in a lot of weird ways. One got on an airplane, right? A guy sat next to me on an airplane.
Yeah.
That was a crazy story. He's like,
hey,
what do you do? He was in real estate, like random. I'm like, I do this thing called cost seg. He's like, wow, I actually heard this podcast about cost segregation recently. I was listening to it. I was like, yeah, that's so interesting. He's like, yeah, let me pull it up. Pulls up the YouTube. It's a picture of me. right? The guy was listening to a podcast that I was a guest on.
This really smart guy was just telling me all about it on this podcast before.
He's like, I was listening to this guy talking about cost seg, and I'm like, that's me. And so that was a crazy way to get a client.
There you go. That's just proof in the pudding that this stuff works, right?
Yeah.
Oh, I love that. Yeah, there's always some interesting stories whenever I ask that question, but airplane's a good one. And then what is your favorite tool? Because we're a tech company, we got to ask. What's your favorite tool or software that you use on the job?
I mean, I use a lot of, social media. So LinkedIn is probably the biggest tool I use, but sure. I'm going to say Calendly because, the scheduling tool, I have it integrated, I have it on my website. I have it in my LinkedIn bio, I have it in, my Linktree and all these different places where I literally get people scheduling and booking calls with me every day. My calendar is like filled up just from this link kind of being out there on various platforms and various places. Yeah. People schedule calls with me. It's all, 99% is, business related. So I do get the random person just kind of scheduling a call with me for no reason. But yeah, that's probably the most powerful thing because it's just integrated. It's automatic. It just shows up in my calendar and I just show up.
You don't have to do the back and forth thing of when does work for you? Or that doesn't work for me. Let me try again. You don't hear back. It's just they pick and it's free.
Exactly.
Calendly's great. I do recommend Calendly. Awesome. Well, this has been so much fun. Extremely educational. I learned a lot. I feel like I sneakily knew some of these tax things just from like a personal perspective, but it's always like, oh yes, like you get excited about these things. So really appreciate you coming on, sharing your wisdom, your valuable knowledge. Where can people get in touch with you besides Googling your name? That might be the easiest. But if they do want to connect with you, listen to you speak more on the topic, where can they connect?
Absolutely. The best place is, I would say, LinkedIn or X, Instagram. But I would highly recommend just take 10 seconds instead of just hitting that follow button. Take 10 seconds and shoot me a quick message. Say, hey, heard you on the Crexi podcast or whatever it is. That way it's more personable. We can start a conversation. It's not just like have this number of followers who I have no idea who anyone is. I'd love to hear feedback. So yeah, please do that.
Absolutely. Please go reach out to him. He's the best. Really, really appreciate it again. This has been so much fun.
Thank you. Thank you again for having me. I really appreciate it.
Yeah. And thank you everyone who tuned in today. If you enjoyed this episode, please don't miss the next one. Visit crexi.com/podcast and sign up to get the next episode delivered straight to your inbox. You can also subscribe to the Crexi Podcast on your favorite podcast app or check out our YouTube channel for video recordings of each episode. Take care and be sure to tune in next time.